A high-yield savings account, Treasury bills, and bond ETFs can all generate income from money that is not invested in stocks, but they are not three versions of the same product. A high-yield savings account is a bank deposit designed primarily for liquidity and a stable account balance. Treasury securities are direct obligations of the United States government with defined maturity dates. Bond ETFs are market-traded investment funds whose share prices can rise or fall. That difference matters because the highest advertised yield does not automatically identify the best place for your money. The correct answer depends on what the money is supposed to do. Emergency cash needs immediate access and should not depend on selling an investment during a market decline. Money reserved for a known expense may benefit from a treasury security that matures close to the payment date. Capital that will remain invested for several years may be able to accept bond ETF volatility in exchange for diversification and potential total return. Each option also comes with a different type of protection. Bank deposits may qualify for FDIC insurance. Treasuries are backed by the full faith and credit of the United States. SIPC may help protect missing customer assets if an eligible brokerage firm fails, but it does not protect investors from market losses. So the real comparison is not simply which account pays more today. It is liquidity, principal stability, taxes, maturity, price risk, and the investor's time horizon. Before comparing yields, we need to answer the most important question of the entire video. What is this money actually for? Every dollar should have a job before it is assigned an account or investment. The first possible job is an emergency fund. This money must be available when the car breaks down, the roof leaks, or income suddenly stops. The priority is not maximum return. The priority is immediate access without being forced to sell at a loss. A high-yield savings account is often designed for this role. The second job is a known future expense. Maybe the money will be used for taxes, tuition, a home purchase, or another payment 6 months from now. In that situation, a Treasury bill maturing close to the required date may provide a predictable schedule and a yield locked for that specific term. The third job is opportunity cash. This may be money waiting for a future investment, portfolio rebalancing, or a business opportunity. It needs liquidity, but perhaps not the same level of immediate access as an emergency reserve. A savings account, short treasury, or very short duration bond ETF could potentially serve that role depending on how much price movement is acceptable. The final job is longer-term investment capital. If the money will not be needed soon, a diversified bond ETF may offer income, automatic reinvestment, and potential price appreciation, but it also introduces market risk. This creates a simple sequence. First, define the purpose, then define the time horizon, then decide how much price volatility the money can tolerate. Only after those questions are answered should the investor compare the rates displayed on the screen. And even then, the numbers are not as comparable as they appear. A savings account APY, a treasury yield, and a bond ETF's SEC yield may all be displayed as percentages, but they do not measure exactly the same thing. A high-yield savings account usually advertises an annual percentage yield. The APY estimates the interest earned over 1 year while incorporating compounding. However, the rate is variable. The bank may increase it or reduce it at any time. A treasury yield reflects the relationship between the security's purchase price, its payments, and the amount received at maturity. With a Treasury bill, the investor usually purchases a security below face value and receives face value at maturity. When the bill is held to maturity, the yield is effectively locked for that term. A bond ETF's 30-day SEC yield is a standardized estimate based on the recent income generated by the portfolio after fund expenses. It helps investors compare funds, but it is not a promised return. The ETF's share price may rise or fall, and its future distributions may change as the portfolio evolves. This is why total return matters. Total return equals income plus or minus the change in market value minus expenses. An ETF with a higher SEC yield could still produce a lower total return if its net asset value falls. A savings account with a lower advertised rate might be more valuable when immediate liquidity and balance stability are essential. Treasuries may become more attractive after considering state tax treatment, so investors should compare after-tax return, liquidity, maturity, and risk, not simply the largest percentage. With those measurements separated, we can start with the simplest of the three tools, the high-yield savings account. The strongest feature of a high-yield savings account is not necessarily its interest rate, it is accessibility. The balance does not move up and down with the bond market. If the account shows $10,000 today, a change in Treasury yields does not suddenly reduce that balance to $9,800. That stability makes a high-yield savings account especially useful for emergency reserves and near-term cash. Access is also straightforward. The investor can usually initiate a transfer through a banking website or mobile application. There is no maturity date to monitor, no auction to understand, and no security that must be sold. Interest is credited automatically, and recurring deposits can often be automated. At an eligible FDIC-insured bank, deposits may also be insured up to the applicable limits. The standard coverage is generally $250,000 per depositor, per insured bank, per ownership category. But investors should confirm that both the institution and the specific account are actually covered. A financial technology application may look like a bank bell depending on a partner bank behind the scenes. The details matter. A HYSA can be especially useful for an emergency fund, a monthly spending buffer, upcoming bills, or money that may need to be accessed without warning. It optimizes for simplicity and liquidity, but the savings account does not lock its rate. The bank controls the APY, and the attractive income can decline quickly when market conditions change. That is where the weaknesses begin. A high-yield savings account provides a stable balance, but it does not provide a stable future yield. The bank can adjust the APY whenever market conditions or business priorities change. If short-term interest rates fall, the savings account rate may fall shortly afterward. The investor still has access to the money, but the future income can decline without any maturity event or approval from the account holder. Some institutions also use promotional rates. A high advertised APY may apply only for a limited period, only to new customers, or only to balances meeting specific conditions. Monthly fees, minimum deposits, and balance requirements may reduce the actual value of the offer. Transfer speed can also vary. The account may be described as liquid, but moving money to an external institution can take time. There may also be transaction limits, holds, or security reviews. The interest is generally taxable as ordinary income at the federal level and may also be subject to state and local income taxes. That means the rate displayed in an advertisement is not the investor's after-tax return. HYSA should therefore be evaluated through a practical checklist. Is the bank insured? Are there monthly fees? Is the full balance eligible for the advertised rate? How quickly can the money be transferred? Can the rate change immediately? The most important benefit of the account is reliable access, not a permanent promise of high income. For investors who know exactly when the money will be needed and want to lock the yield for that period, Treasury bills offer a different structure. Treasury bills are short-term obligations issued by the United States government. Unlike a savings account, a Treasury bill does not normally pay a variable bank rate into an account every month. The investor typically purchases the bill below its face value and receives the full face value at maturity. For example, an investor might hypothetically pay $9,800 for a Treasury bill that pays $10,000 at maturity. The $200 difference represents the investment income. The exact price depends on the maturity and market yield. The primary advantage is that the return can be known when the security is purchased and held to maturity. If the investor buys a 6-month Treasury bill, the yield is effectively locked for those 6 months. A bank cannot reduce it halfway through the term. Treasuries may also offer a tax advantage. The interest is generally subject to federal income tax, but exempt from state and local income taxes. That can improve the after-tax result for investors living in states with higher income tax rates. Treasury bills also have defined maturity dates. An investor expecting a tax payment in 3 months can purchase a bill maturing around that date. Several bills with different maturities can be combined into a ladder for multiple planned expenses. Treasuries are backed by the full faith and credit of the United States, but they are not bank deposits and are not FDIC insured. Their protection comes from the government's repayment obligation. This structure can be useful, but it is less convenient than an on-demand bank balance. To use Treasury bills effectively, investors must understand the operational friction. Treasury bills are straightforward once they are owned, but the process requires more planning than a savings account. The investor must select the maturity, place an order, and decide whether to purchase through a Treasury auction or the secondary market. After the purchase, the money is committed to a security with a defined maturity date. The Treasury bill can usually be sold before maturity through a brokerage account, but the sale price is not guaranteed. If market yields rise after purchase, the bill may be worth slightly less. For very short maturities, the price movement may be modest, but it still exists. Holding to maturity provides greater predictability because the investor receives the face value, assuming the government makes the payment as promised. Reinvestment is another decision. When a bill matures, the cash must be spent, transferred, or invested again. An auto-roll feature may help, but investors need to understand the timing. There can be a gap between the maturity payment and the settlement of the next purchase. Brokerage procedures may temporarily affect when the cash is available. A Treasury ladder can reduce concentration around one maturity date. For example, bills could mature every 3 months, creating repeated opportunities to access or reinvest a portion of the cash. But the ladder still requires management. Future yields may be lower, and each maturing security creates another reinvestment decision. So, Treasury bills provide known maturity values and potentially attractive after-tax income. They do not provide the exact same instant access as a bank account, and they should not be confused with bond ETFs, which have no single maturity value for the investor to wait for. A bond ETF may hold Treasury securities, corporate bonds, or other fixed income assets, but owning shares of a bond ETF is not the same as holding cash or an individual Treasury bill to maturity. A traditional bond ETF owns a rolling portfolio. As bonds mature or no longer fit the strategy, the fund replaces them with new securities. The ETF itself generally has no final maturity date and no single face value that will automatically be returned to the shareholder. Its net asset value changes every trading day. If market interest rates rise, existing bonds with lower coupons may become less attractive, causing the ETF's value to decline. The size of that decline depends partly on duration. An ultra-short bond ETF may move only slightly. An intermediate or long-duration fund may experience a much larger drawdown. Credit risk also matters. A corporate bond ETF may lose value if investors become concerned about defaults, even when Treasury yields are stable or declining. The market price may also differ slightly from the underlying net asset value because ETF shares trade throughout the day. Fund expenses reduce returns as well. This does not make bond ETFs bad products. They can be useful investment tools. But emergency cash should not depend on selling ETF shares at a favorable price. If the investor must withdraw a specific dollar amount next week, even a small market decline can create an unnecessary loss. The word bond describes the portfolio's assets. It does not guarantee that the account balance will remain stable. Once that distinction is understood, we can examine the circumstances in which a bond ETF may actually be the stronger choice. A bond ETF may be more useful when the money has an investment horizon rather than an immediate spending deadline. The first advantage is diversification. One ETF can hold dozens, hundreds, or even thousands of individual bonds. That reduces dependence on one issuer or one maturity. The second advantage is automatic portfolio management. As securities mature, the fund reinvests the proceeds and maintains its intended duration and credit profile. The investor does not need to rebuild a Treasury ladder manually. Bond ETFs also provide choices. An investor can select ultra-short, short, intermediate, or long duration. The portfolio may focus on treasuries, investment-grade corporations, high-yield debt, municipal securities, or a broad mixture. Most importantly, bond ETFs offer total return potential. If market yields decline, the bonds already held by the fund may become more valuable. The ETF's net asset value could appreciate, especially when its duration is longer. This creates an important difference during falling rate environments. A savings account APY may be reduced, a Treasury bill keeps its yield only until maturity. A bond ETF's income may gradually decline as the portfolio reinvests at lower rates, but its share price may rise as existing bonds gain value. That result is possible, not guaranteed. Yields can rise instead, producing a price decline. Bond ETFs therefore fit money that will remain invested, can tolerate daily market movement, and is intended to generate income or diversify a broader portfolio. They are investment tools, not substitutes for emergency cash. At this point, the larger lesson becomes clear. The goal is not to chase the highest visible yield. If you prefer cash management analysis without bank marketing, yield chasing, or one-size-fits-all answers, subscribe to Boring Money Wins. The goal of this comparison is not to declare one product the permanent winner. It is to understand what each tool is designed to accomplish. A high-yield savings account may be the best choice for money that must be accessible without market price risk. A Treasury bill may be the better tool when the investor knows the future payment date and wants to lock a yield until maturity. A bond ETF may be more appropriate when the money has a longer horizon and can accept price volatility in exchange for diversification and potential total return. If this video is helping you look beyond the advertised interest rate, click the like button. That helps YouTube recommend the video to more investors trying to make intelligent decisions with their cash instead of simply moving toward the largest number on a promotional screen. Cash management is risk management. The investor is balancing access risk, reinvestment risk, market risk, inflation risk, and the risk of earning too little after taxes. And taxes can change the ranking. A treasury with a slightly lower pre-tax yield may produce a better after-tax result than a savings account for someone living in a high-tax state. A bond ETF may distribute several different types of income, so the next step is comparing what the investor may actually keep, not merely what the product advertises. High-yield savings interest is generally taxable as ordinary income at the federal level. It may also be subject to state and local income taxes. The bank commonly reports the interest on Form 1099 INT. Direct Treasury interest is also generally taxable at the federal level. However, it is normally exempt from state and local income taxes. That exemption can be valuable in states with higher tax rates. This means a Treasury bill does not always need the highest pre-tax yield to produce the strongest after-tax result. Bond ETF taxation is more complicated because it depends on the assets held by the fund and the types of distributions made. A Treasury-focused ETF may distribute income that is partly eligible for state tax exemption. However, investors may need to determine what percentage of the fund's income came from qualifying Treasury obligations. Corporate bond income is generally taxable at both federal and state levels. Municipal bond funds follow a different tax framework. The ETF may also make capital gain distributions, and selling shares can create a separate capital gain or loss. A simplified after-tax comparison starts with the pre-tax yield and reduces it by the applicable tax rate. But investors should avoid applying one tax rate blindly to every product. The correct analysis may require federal taxes, state taxes, fund composition, account type, and the investor's individual circumstances. Tax-advantage retirement counts can change the calculation again. The practical lesson is simple. Compare after-tax income using equivalent assumptions. Do not assume that an account paying 4.2% automatically beats a treasury yielding 4%. And taxation is only one part of the safety question. The protections surrounding each product are also completely different. FDIC insurance, Treasury backing, and SIPC protection are often mentioned together, but they protect against different failures. FDIC insurance applies to eligible deposits held at insured banks. That can include checking accounts, savings accounts, money market deposit accounts, and certificates of deposit. The standard coverage limit is generally $250,000 per depositor per insured bank per ownership category. It protects eligible deposits if the insured bank fails. It does not protect the investor from inflation, a declining APY, or uninsured deposits above the applicable limit. Treasury securities rely on a different form of protection. They are direct obligations of the United States government, backed by its full faith and credit. This is not FDIC insurance. A Treasury security can still change in market value if it's sold before maturity. Government backing addresses the repayment obligation, not the price available in the secondary market today. SIPC applies at eligible member brokerage firms. If a brokerage fails and customer securities or cash are missing, SIPC may help restore those assets within its coverage framework. The general limit is up to $500,000 per customer, including up to $250,000 for cash. But SIPC does not compensate investors because a bond ETF declined in value. It does not reverse a poor investment decision. The central distinction is between protection of the account structure and protection of the investment's market value. FDIC may protect eligible deposits. SIPC may help recover missing brokerage assets. Treasury backing supports government repayment. None of these mechanisms guarantees a positive real return. Once these protections are separated, the three products can be assigned to different cash buckets more intelligently. Investors do not need to force one product to perform every cash management job. A three-bucket structure can separate immediate cash, planned cash, and investment capital. The first bucket is immediate cash. This includes the emergency fund, monthly spending buffer, and money that could be needed without warning. A high-yield savings account may work well here because the balance is stable and access is relatively simple. The second bucket is known date cash. This is money reserved for taxes, tuition, a home purchase, or another planned expense. Treasury bills can be matched to those dates. A ladder may contain several maturities, allowing portions of the principal to return at regular intervals. When a bill matures, the cash can replenish the savings bucket, fund the planned expense, or be reinvested. The third bucket is investment capital. This money has a longer and more flexible horizon. A short or intermediate duration bond ETF may provide diversified fixed income exposure, portfolio income, and potential price appreciation. But the investor accepts that the market value will fluctuate. The time horizon should generally become longer as price risk increases. A savings account may support money needed today. A treasury held to maturity may support a payment scheduled several months from now. A bond ETF should usually have enough time to recover from normal market volatility. This structure also improves behavior. The emergency fund does not need to be sold during a downturn. The Treasury ladder provides scheduled liquidity. The bond ETF can remain invested instead of being interrupted by near-term spending needs. The goal is not maximum yield in every bucket. It is matching every risk to the correct financial job. That brings us to the final decision framework. So where should your cash go right now? A high-yield savings account may fit when immediate access is essential, a stable account balance is required, and the money serves as an emergency reserve. The investor accepts that the APY is variable and confirms that the institution and account are eligible for FDIC insurance. Treasuries may fit when the money has a known future date. The investor wants to lock a yield for a specific term, and state tax efficiency is valuable. The investor accepts maturity management, reinvestment decisions, and possible price changes if the security must be sold early. Bond ETFs may fit when the money has a longer investment horizon, daily price changes are acceptable, and the goal includes income, diversification, or total return. The investor accepts duration risk, credit risk, and the absence of a guaranteed principal value on one final maturity date. The final decision can be organized into 7 questions. What is the purpose of the money? How quickly might it be needed? Must the dollar balance remain stable? Is the rate variable or locked? What is the after-tax return? Which form of protection applies? And can the position be sold during a market decline without damaging the financial plan? The final verdict is straightforward. A high-yield savings account optimizes for access. Individual treasuries optimize for known maturities. Bond ETFs optimize for investment exposure.
The highest yield is not always the highest quality decision. Do not chase a temporary rate with emergency money. Do not accept bond market volatility for capital needed next month. And do not leave long-term investment capital permanently idle simply because cash feels comfortable. Match the time horizon, understand the protection, accept only the risks the money can afford, and keep emergency cash boring. That is how boring money wins.